Okay. Yeah, you're next one after Jan. Okay, so. Okay. Okay. Thank you very much for coming to this book launch. Can I pass this microphone over to Victoria Chick, who will be presenting no, I'll pass over to Yanis Stefanos, who will give the welcome on behalf of the department.
Thank you, and many thanks for joining us today. It's a great pleasure for me to welcome you to this book launch on behalf of the Department of Economics. And the book that Jan is launching today, I think it's a very important contribution to our understanding of the economics of Kalecki. And what I think is very important is that Jan emphasizes these monetary aspects of the work of Kalecki. We know that he has worked so much and has contributed so much to our understanding of the monetary aspects of Kalecki. And one of the reasons why, in my view, this is very crucial is because if we look, for instance, at the way that young heterodox economists think about Kalecki, in most cases, they focus quite a lot on the real economy aspects of Kalecki. They know very well, for instance, his analysis about oligopolies, trade unions, the links between economic growth and inequality, his analysis about the business cycle. But what is very important is that they don't know very well the monetary and financial aspects of the work of Kalecki. And I think this book and overall the work that Jan has done on Kalecki highlights this and allows people to understand why, for instance, we have to read Kalecki in order to understand what is the impact of interest rates on investment, the role of corporate finance, how we can conceptualize central banking nowadays, debt management. All these issues are very important. I think that especially young heterodox economists are not very much familiar with them. And in most cases, when they work on finance issues, they rely, I mean, especially if they use Post-Keynesian insights, they rely a lot on Minsky. And I think the fact that we have this work of Jan is very important because it's a way for young economists to engage with this. Another thing that I would like to emphasize is that the Department of Economics at SOAS is, I think, one of the very few departments that gives the opportunity to students, both at the postgraduate and the undergraduate level, to engage with Kalecki. For example, I mean, in my macroeconomics module, I always give students the very well-known article of Kalecki about the political aspects of full employment, which is an article that emphasizes why it's so important to analyze economic phenomena in conjunction with the distribution of power between different classes. And I think students enjoy that very much, and they overall enjoy very much the insights of Kalecki. And it's really a pity that we don't have this in most economics departments. I mean, Kalecki is not taught in macroeconomics modules, in finance modules. And again, this is why I think that what Jan has done over so many years is quite important, is very important, because it's also a very good teaching material. And hopefully in the coming years, we are going to see Kalecki more in the teaching of economics. So it's a great pleasure for the department to host this event today. I very much look forward to the discussions, and I'm so happy that so many of you, friends, colleagues are here. And many congratulations to Jan for all the work that you have done on Kalecki, and enjoy the event. Thanks a lot.
Better? Good. Seems to write books as frequently as most of the rest of us send off postcards. It seems an almost daily event that there's a book launch here. for one of his efforts. The last one I remember was the second volume of the Koletsky biography. And he, I think very wisely, chose to write another volume on Koletsky's monetary theory, which really doesn't get the kind of press that a lot of Koletsky's work does. It sort of sits by one side, and to have it brought out like this, very often in this case, by finding fragments of arguments and putting these arguments together, that is a very great boon to us all. We have three wonderful speakers. The other thing that Jan manages always to do is to get the very best speakers. The first is Gary Dymski, now from the University of Leeds. He started his career in America, more or less all over the place until he ended up in California, at first at University of Southern California, and then University of California at Riverside, but decided that Britain was the place to be because the population density was such that there was a real chance of academics talking to one another.
It's true.
And it's true. Thank you. It's true. That's why he's here, and I'm delighted. In the States, he also played quite a strong role in various government departments. And in Leeds, he's also doing something for the city council. Very importantly, from the point of view of putting this meeting together, he's on the committee of the Post-Keynesian Economic Society, and is looking at Koletsky perhaps from that point of view. So I give you Gary. I would like to introduce all the speakers at one time, but it's a little awkward to do, so I guess I'll break in each time. They have about 15 minutes maximum, 10 would be even nicer, to say their piece. Gary.
I appreciate that. I will do my best.
Good boy.
Stop watching.
I don't even have one, so.
So I have a lot to say, and I've been up. Good now? Yeah. And I've been in dialogue with Jan and learned from Jan so much over the years by both reading and talking with him. And so it was I really wanted to do justice to this volume here, which I think is a real milestone. It is true he writes many books, but this is something special. And I was able to distill my thinking about it. And I'm going to kind of read with expression what I've written so I can discipline my mouth and say all that I want to say. So Jan starts his book with a confession that it is true that Koletsky consistently underplays monetary factors. And indeed, as he refined his formulations, he pushed money even further into the background. Now, this book here, this is a scholar's book, and its entry point, therefore, confronts its reader with a paradox. That is, why a book called Interest in Capital about Koletsky? How does that work? Now, my decoding of Jan's intention is the following. Highlighting the often implicit monetary components of Koletsky's work in an exposition, his exposition, that connects with Koletsky's overall vision of the capitalist accumulation process, permits a deeper confrontation with the limits of neoclassical theory than would a critique that was based merely on the obvious mischaracterizations in neoclassical theory. To give an example, If you've seen the May 2015 working paper by Jacob and Kumhoff that just brutally flogs the exogenous money theory, you can do things like that, and that's fine. It's descriptively wrong. But Toporowski has a deeper target here. He wants to take on the edifice of equilibrium-based neoclassical macro theory, both in its older and its newer forms. And like Kalecki's formal models, these models too de-emphasize the role of money in economic dynamics. And so, monetarism trivializes it. And of course, the DSGE model, as we know, eliminates it. And I should say, I know I'm speaking economic ease, but that's the level at which the book is written. So with due apologies. His attack links this erasure to another erasure, neoclassical theory's elimination of any role for the capitalist firm. There in that theory, households are producers. This simplification leads directly to another deep theoretical error that Jan wants to correct. The idea that interest is linked to profits in a zero-sum relationship. So just to remind you, the neoclassical model, agents automatically earn an expected return R for saving, and whether, or for waiting, if you will. So whether you think of this R as an interest that you pay yourself or as a profit that your production earns doesn't make any difference. Notice that the real business cycle kind of morphed into DSGE and nobody really cared because it doesn't make a difference. It doesn't matter. There's only the representative thing that's at the center of this nothingness that's neoclassical theory. In that framework, R and the assumed availability of putty capital production technology governs agent choice. Rational agents automatically generate the finance that they need for the appropriate technology. Finance remains invisible because it's completely passive and dutiful. You don't need to see it, and therefore it's out of the theory. This trade-off between interest and profit is one manifestation of what Keynes called the classical model, and what's here called by Jan the Wicksellian approach. It's kind of because he's kind of making that monetarist connection pretty deeply. In that model, savings in advance are required to finance investment, and aggregate demand has no role in economic growth. Now, of course, Keynes' revolution against the classical Pigovian denial of the necessity of macro policy took on precisely these premises. But how? Well, here's where we come with the first really fundamental point that Jan's making. Keynes' angle of attack on the Wicksellian argument that the interest rate itself governs the pace of economic growth builds on the notion, Keynes goes by saying, uncertainty begets fear, and that destroys conventional beliefs, and that gives rise to liquidity preference, which undermines investment. And it's not the absence of saving. Fair enough. But fear and liquidity preference in turn can be offset in that Keynesian vision, the vision we see in general theory, by basically maintaining a robust level of aggregate demand by appropriate monetary policy, et cetera. So everything depends on government policy, on what Minsky called big government, big bank, in the face of recession. While this shows that how accumulation can falter, it does not describe the actual dynamics of capitalist accumulation. Government stabilization policy takes center stage, while capital and capitalist firms remain offstage. Keynes has adopted what Minsky would later proudly describe repeatedly in conversation and in print as the Wall Street view of the capitalist economy. I don't know if you're saying that when you were there with him in Berkeley, but that was his mantra. And if you see that, there's a sense in which, he's kind of that Wall Street view. It says a lot about the limits and the potentials of Minsky's view as well. Now enter in Toporowski's Kaleckian corpus. This puts this capitalist firm center stage by focusing on corporate finance, not liquidity preference. The competition amongst capitalist firms, which involves investing when financing conditions are favorable, takes the place of liquidity preference. So greed, driven by fear of being overtaken by rivals, takes the place of the fear of uncertainty that can kill capitalist entrepreneurial drive. And capitalist firms' competition gives rise to a business cycle whose lifeblood and whose aggregate demand-driven aspect is the economy's monetary circulation. That monetary circulation is driven by what Jan calls capitalist money. It's the money of capitalists that you need to understand capitalist dynamics, not the money of government. There's another really provocative point in the book, well worth much reflection. And so that leaving that there, a perhaps surprising implication of this approach, something I hadn't fully realized, is that interest is not limited by profit. Instead, Jan points out, finance is flexible. Capitalists themselves and the banks on which they rely for credit are able to generate the money they need. Interest can be paid from the profits that will be realized once the investment thus triggered works through the expenditure multiplier. So Kalecki is the shield that Toporowski uses to confront, in a sense, the hydra-headed beast in a certain way, to build monetary elements into a framework that prioritizes the essential features of capitalism. This shield lets him take on the neoclassical orthodoxy and also calls into question, implicitly in the main, some heterodox understandings of capitalism. So I've got 5. One is the romance with Schumpeter. Now, keep in mind, 2 weeks ago, I met with the people over at the IIPP at UCL and that whole thing. So it was kind of in my mind as I was reading this book. The idea that understanding capitalist growth is continually renewed, that understanding why capitalist growth is continually renewed requires that we make space for Schumpeter's entrepreneur. No, actually, in Toporowski's Kaleckian world, capitalists are not romantic dreamers. They're fierce beasts who give no quarter and invest to dominate. Toporowski reminds us that the core requirement for becoming a capitalist is to already own capital. That's third fundamental point that's made here. Basically, the power of capital is the basis of the process. We should not pine for worthy entrepreneurs whose blossoming requires only that they be connected with finance. Capitalism doesn't work that way. And in our work up in West Yorkshire and Leeds, this is something that we're confronting as a reality. How do you overcome that divide and level up and all of that? Because it is what it is. It works as it works. Secondly, there's a gentle corrective for the Keynesian stock flow consistent models. Keynes's failure to ground his monetary theory in real-time dynamics driven by capitalist firms is reproduced in SFC modeling as such. The SFC model is, after all, a rediscovery of the Tobin-Brainard macro portfolio equilibrium. That's an accounting framework that emphasizes point-in-time stock consistency and largely ignores motion through time. If you go and trace through Tobin's work on that model through time, he always reverts back to the equilibrium. And I know there's kind of jumped the other way, and Giannis, many of our theorists today are working on and having a fuller vision. We have to keep in mind that that equilibrium is there as the test of the thing. And once we go into other directions, then it challenges, are we in a sense pushing that framework beyond where it really can go as a description of capitalism? This is something that's posed and that in a sense Jan puts on the table. So this framework accounts for capitalism's scorecard, the balance sheets, but doesn't track the circuits of capitalist circulation in time. So in some sense, there's this kind of dialogue that we always have to have with the regulationists, with the circuit of capital folk, and with SFC. We need all of those elements. And of course, that's one of our contemporary challenges, as in a sense it was for Kalecki. Third, this volume's argument warns, again implicitly, against the idea that purposive smart government initiatives can rescue capitalism from its contradictions. Neither mission-driven growth nor monetary theory are mentioned here in this book, but both of those turn on the idea that the failures of capitalism can be effectively countered by available policy levers, an idea that Jan's book calls into question. There is a debate to be had here. Fourth, this volume briefly criticizes the literature on the financialization of capital, another really provocative finding in the book. The idea that there's too much finance and reducing finance would be a cure. My gut, right, I believe with that, all my work on the mega banks and all of that. But Toporowski reminds us that more finance can save capitalism from its own contradictions. Financialization embodies a crisis of one kind, but it also presents a means of escaping from crisis. Could we not say that this is a kind of Marxian dialectic in motion? The insistence on the importance of modeling the capitalist firm and its financing process represents a view that planning and controls over investment finance, which is mentioned a lot in this book, that is, explicit intervention into the drivers of aggregate demand and supply, are needed no matter the form taken by the social relations of production. So it has to be said that going all this way with Toporowski's drilling down into Kalecki's vision of capitalism does entail some costs, and there's some kind of points of critique or further discussion. One is that Jan's effort at carving out a clear divide between the money of capitalists and the money of the state arguably goes too far. It's a really provocative point to read and to reflect upon. And so I think that it's important for us to think about state and economy, Polanyi and all of that. But there's much to be said there that for further exploration. Secondly, his assertion that capitalists do what Kalecki says they do, that they invest by fiercely investing, they fiercely compete to generate profits, is questionable in a world in which the circuits of industrial capital are paralleled by the increasingly dominant circuits of financial capital. The latter are based on speculation or buying to sell, as Minsky would put it. So whereas capitalists made profits by exploiting workers in Kalecki's time, today there are capitalists who make profits by taking positions and fees in their own enchanted world, to use Alain Lippiatt's phrase. And the rentiers, of course, are there earning their share of Piketty's 1%. Thirdly, Kalecki's two-class formulation, the assertion that workers are workers, is also problematic. In our time, people are divided by processes of inter and intra-class competition into the class fragments that are described by stratification theory. There's no recognition in this volume that the concentrated power of large capitalist firms and banks and their shadow bank empires has been used to super exploit those that are socially marginalized by divides of race, ethnicity, gender, or national borders. There's also no attention here to problems of developing nations. Now, I got to say, this is a short book, and we're making some fundamental theoretical points here. So I'll hang on for my finale in a minute. So finally, this volume's discussion of monetary policy leaves much unsaid about the new era of quantitative easing. The transformation of money markets and position taking in pre and post-crisis financial markets has forced central banks to be not just lenders of last resort, or as Perry Merling would have it, dealers of last resort, but actually to be everyday participants backstopping the barely controlled and often out of control gyrations of the over-leveraged financial markets in which the mega bank dominated networks stake out their positions. That's the world in which we live. That world, rooted in the dollar's exorbitant privilege and sustained by the Federal Reserve, catches Western economies in debt tracks that are deepened by COVID-19 now and by the Ukraine war. Not much is said about it in this volume, which would categorize these machinations as components of the money of the state, not the money of capitalists. So I'm out of time, so let me just say that there's something to be considered. And my final paragraph, in the next crisis period, a post-Trump US Fed will lack perhaps the policy space that Ben Bernanke was able to use to stretch the system to meet the 2008 Minsky moment. To create a post-capitalism that can survive the 2030s, we'll need more than economic insights that, no matter how prophetic, are rooted in the conditions of the capitalism of the 1930s. This means that we cannot allow this stellar monetary theorist to rest. We're going to need the next installation of Toporowski's reflections as he and we follow the arc of history. Thank you so much for your attention.
Much, Gary. Well, Bill is making his way forward. I'll start to introduce him. Bill Allen worked for many years for the Bank of England. And since then, or during that time, in fact, also advised the IMF and various other bodies, and wrote, at the time, shortish articles on what the Bank of England was doing. And since then, 2 books have turned up. Jan, in introducing Bill on another occasion, described him as a central banker who thinks about what he's doing. And I don't think you can really ask for a higher accolade than that. I think at the moment you're working for NISA or working with
Yes,
NISA?
I'm
Working with
associated.
NISA, yeah. So he moves around a lot in good places, but he's spending a little time with us. Please keep track of the time yourself because I've come out without my watch. 15 minutes maximum, 10 minutes is better.
Okay,
Off you go.
thank you. Is this turned on? Yeah, okay. Thank you very much. One of the many virtues of Jan's fascinating and perceptive book is that it devotes a lot of attention, 2 chapters out of 12, to open market operations. And that's what I'm going to talk about this afternoon. As he rightly points out, open market operations have been assumed away into irrelevance by a lot of theorists. And so it's a very valuable contribution from him to have kind of resurrected them from oblivion. They are an essential feature of central banking and of monetary policy. And of course, they've been undertaken on a colossal scale since the financial crisis. They haven't always been essential to central banking. Under the gold standard, they were not necessary strictly, and they were widely thought to be undesirable. The stereotypical bank of issue, as they were called in those days, confined itself mainly to discounting bills of exchange. It determined the discount rate and the quantity of bills that it was willing to hold. If holders of its banknotes returned them in exchange for gold as they could, the bank of issue was supposed to let its gold reserves fall in parallel so that money market conditions got tighter and interest rates went up. And that was the automatic magic mechanism of the gold standard, the rules of the game. The reason why open market operations were thought to be undesirable was that they interfered with the direct relationship between the central bank's gold reserves and the domestic monetary situation. They were a way of bending the rules of the game. And of course, that's also the reason why they were thought to be a good idea. The purpose was to absorb some of the shocks that were imparted by the automatic functioning of the gold standard. So the central bank has accumulated reserves to excess in good times when it was plentiful and interest rates were low, so that it could release the gold in bad times when interest rates were high. So it was a kind of counter-cyclical thing. Jan describes how the Federal Reserve discovered the power of open market operations by accident in 1922, when the Federal Reserve banks, looking for income, started to buy government securities so as to make their income bigger, and happened to notice, or their statistical department noticed, that when they did so, the demand for credit from the commercial banks got smaller. And it was the Federal Reserve too, in the early 1930s, which pioneered the extension of open market operations into what's now called quantitative easing, by purchasing such large amounts of government securities that the commercial banks ended up with large excess reserves. And that's been hailed as a great success by monetarists, and with some justice. But even so, the scale of quantitative easing in 1931 to 1933 amounted to the equivalent of something like 2 or 3% of GDP. In other words, only a fraction of the amounts that have been done in the past 13 years. That was still in the gold standard era, just. When exchange rates floated, open market operations became not just a good idea, but essential. Their purpose was often described in the Vixelian language that Jan uses in chapter 10, keeping market interest rates in line with the so-called natural rate. Making bank rate effective was what Richard Sayers called it in his history of the Bank of England. Now, jumping forward a bit, in 2009, quantitative easing was an emergency response to the collapse of the banking system. Since then, it has gradually become the preferred technique for monetary easing. There have been other devices which have been used, but they've all been dropped. Quantitative easing has kind of endured. Quite rightly, extremely usefully, Jan's book draws attention to the immutable but widely forgotten relationship noted in 1963 by James Tobin between monetary policy and government debt management. It's more relevant than ever today, certainly more than 1963. Quantitative easing, in effect, has greatly shortened the maturity of the government debt, nowhere more so than in this country. I don't think this has been widely recognized, at least until recently. If a central bank is free to do quantitative easing, then there is unavoidably a latent conflict between its freedom and the Treasury's ability to discharge its responsibility to maintain stable public finances. Of course, in this country, the central bank isn't completely free to do quantitative easing. It needs in advance the approval of the Treasury for each tranche, as it were, of quantitative easing. That being so, it's hard, at least hard for me, to understand why the Treasury has been ready to give its approval for such large amounts. One probable reason, though it can't be the only one, is that in March 2020, when the coronavirus pandemic became obviously serious, quantitative easing was represented in part as a market maker of last resort operation or a dealer of last resort operation. And that was in an environment where government bond markets had ceased to function as the seriousness of the pandemic became apparent. Now, the Treasury needs a reliably liquid market in which it can be confident that it can sell its securities. And a market maker of last resort was certainly needed at that time in March 2020. But the functions of a market maker are to facilitate trading by quoting bid and offer prices and to achieve price discovery by matching bids and offers over time. So market makers buy and sell. The Bank of England didn't buy and sell, it bought and bought and bought. Now, the only possible interpretation of its actions is that despite what it said, it wasn't acting as a market maker at all in any meaningful sense. It was actually pursuing a rather loose form of yield curve control in which it didn't announce its objectives for bond yields and maybe didn't have any precise objectives for bond yields, but nevertheless suppressed the market forces that would otherwise have caused yields to rise. And by doing so, as I explained, shortened the maturity of the debt. Now, there aren't many instances of yield curve control in monetary history that I'm aware of. Both the United States and this country employed it during the Second World War to keep down the interest cost of government debt. Of course, there was a huge amount of borrowing going on then. In both cases, there was a period, not entirely unrelated, of post-war inflation and a rise in bond yields. So a substantial fraction of the cost of the war was borne by bond investors who suffered real losses on their assets. Much more recently, Japan has used and is still using yield curve control for a prolonged period and hasn't experienced any significant inflation. In Britain, inflation has increased, as you all know, in the past year, and bond yields have gone up a bit. Up to the end of February 2021, quantitative easing had produced a large mark-to-market profit for the Treasury, which they had taken and spent of £112 billion. But the Treasury is also responsible for the losses which will have been incurred in the latest year and for future losses if bond yields continue to go up. So Jan is quite right to say that open market operations have a fiscal component. It's a very big fiscal component. And more generally, monetary and fiscal policy are ultimately indivisible. So Jan's decision to say so much about open market operations is timely and welcome, and a very important contribution to the current debate about monetary policy and debt management. As I said, recent writers on monetary policy have generally assumed them away. Even the Bank of England has tried to separate open market operations from monetary policy by not allowing its monetary policy committee to decide exactly what open market operations are to be done. They have to choose from a menu which is approved by the executive body of the bank. They should know better, and I hope that they and many other people will read Jan's excellent book and learn from it. Thank you very much.
So much. Next on our menu is Jeff Tiley. Jeff also has a variety of careers. He spent a great deal of time having been trained as a statistician at UCL, at the ONS, Office for National Statistics, and is one of probably the three best informed people on the national accounts in this country.
One of three.
Still poring over those while he works for the TUC, but many other things have claimed his attention as well. When the ONS moved to Wales, that was the end of Jeff and the ONS, and he worked for a while for the Treasury.
No offence to Wales.
No offence to Wales, just offence to the ONS. Quite rightly too. And well, it was a rather silly move. They should have known they'd lose all their good people. But anyway, he worked for the Treasury for a while, and then at some point decided to come back to UCL, where he trained as a statistician, to do a master's degree in economics. And he came across me, and he came across Keynes, and the combination was irresistible. So he did a PhD on Keynes in the Post-Keynesian frame of reference, Keynes Betrayed, which is probably still his best single work. Much happier now in the TUC and tremendously productive. Both his work on the national accounts and on Keynes are proceeding pace as he goes, and he will have interesting things to say about Jan's book.
In 15 minutes or less.
At most.
Thank you, Vicky. Sorry about the small handouts, but hopefully it's appeared on the screen. Well, thank you for inviting me, and thank you for that introduction, Vicky. So at one level, I have much sympathy for Jan's project. In reviewing Kalecki's monetary analysis, he is reviving monetary debates, which have been a central preoccupation of my work. But he appears to resolve the debates in favour of Kalecki, citing and I think agreeing that monetary factors are of no fundamental importance for the mechanism of the business cycle, and rejecting the notion that the rate of interest affects the dynamics of the real economy. And when it comes to policy, the regulation of private investment was the most problematic way of securing full employment. I argue exactly the opposite, in my book, Keynes Betrayed, which Vicky's just mentioned. And Jan knows this, not least because he reviewed the hardback in 2008. He did so in an extremely generous way, and I've always been incredibly grateful for his willingness to give time to my work and for the broad reach of his scholarship. Nearly 20 years ago, he introduced me to J.A. Hobson, and only last year to the equally valuable Jean-Claude Leonard Simon de Sismondi. Anyway, my remarks are organised in 4 sections. First, I'm going to try and put matters in the context of post-Keynesian debate. Then I'm going to set out my take on Keynes very quickly. Third, I'm going to comment on what I see as the a priori nature of Kalecki's critique. And fourth, I'm going to try and look at some sort of reconciliation. So Jan opens his book wanting to detach Kalecki from Keynes, but I'm not the right person to do this. My reading of Keynes leads me to contest Keynesian economics on 2 main grounds. On theory, I want to get away from simultaneous equations that are opposed to Keynes's method. And then on policy, I want to emphasize monetary factors with fiscal in second place. It has always seemed to me that Kalecki rivals both. Moreover, while the policy debate was fundamental, it has been obliterated. In his review, Jan noted that relevant debates with Kalecki were omitted from Keynes's collected writings. And here Kalecki himself is a little slippery. He claimed to discover the general theory ahead of Keynes, but at the same time disputed Keynes's central conclusions around the rate of interest. For me, if Kalecki has precedent, it is precedent for Keynesian economics. I sense in Jan's book some discomfort on the monetary front. He notes that Kalecki may have been too confident about the explanatory power of his mathematical models. But for me, an opportunity has been missed, not only to confront the 2 approaches in a more neutral manner, but also to confront some of the murkiness of the economic debate that we're all interested in. So, to my take on Keynes. Because the policy debate was obliterated, I'm obliged to revive the arguments that Kalecki dismissed on the assumption that, unfortunately, you are not all familiar with my Keynes Betrayed. Above all, Keynes was concerned with the cause and prevention of crisis. The focal point of his analysis was the classical theory of interest. And on page 75, Jan emphasizes how money capital and bank credit make that theory redundant. Keynes broke the link with supply side factors of thrift and technology and argued instead that the rate of interest could be set by policymakers. Over the 1920s, policymakers had allowed dear money to prevail, and he regarded this as the fundamental cause of the Great Depression. He required of policymakers a cheap money policy, a secular policy of low interest rates across the spectrum from short-term to long. Immediately, this was a precondition for recovery, but more substantially, it was critical to the prevention of future crisis. His cycle process followed then from the interplay of the rate of interest, investment and animal spirits, captured by his marginal efficiency of capital, as illustrated on my small handout and on the chart behind me. My concern was always beyond just history. I began to get preoccupied with dear money as I did my PhD research in the late 1990s. I saw the Volcker shock and financial liberalization as bringing to a decisive end the cheaper money of the golden age and restoring the monetary environment of the 1920s. So on the chart, we move from point K with high investment and low interest to point V with low investment and high interest. But this was increasingly coming alongside excess, not least in the dot-com boom. On this view, dear money becomes combined with a shift in the MEC to get exaggerated investment outcomes at point G or Greenspan. According to the precedent of the 1920s, this would not last, and sure enough, it didn't. I'm bound to find some vindication for my account in the subsequent and ongoing crises of the 21st century. But as the crisis hit, policy got even worse, as we all know. For some,
After some immediate rescue action, policymakers reverted to type. The OECD called for austerity that would be brutal for some countries. And fundamental to the idea of austerity is the notion of living beyond our means. So excess at position Greenspan meant that we had to suffer at best point Volcker, but immediately, given the collapse in the MEC that is characteristic of financial crisis, the even worse point Bernanke. Needless to say, Keynesians of all types were united to howl with rage, but with the MEC lost in the algebra of Keynesian and Kaleckian economics, the full force of Keynes's argument is not brought to bear. For me, Kalecki is concerned with the economics of this collapsed MEC, and plainly the difficulties of revival are immense. But let me stress first that we confront these difficulties because policymakers were ignorant of or disregarded Keynes's prescription of prevention. Second, even in the case of fiscal policy, it is more difficult to make without recognizing the existence of point K. We were never living beyond our means. We were, and still are, living in the economic disaster zone of a dear money economy, and we can and we must live greatly better. Let me now turn to my third main point, that Kalecki's critique was a priori and impervious to outcomes. Jan cites commentary from 1933, with Kalecki arguing the rate of interest is endogenous to the credit cycle. I want to stress he was doing so just as politicians were for the first time making progress with not only reducing interest rates, but with wresting monetary policy from the hands of central banks and financial interests. Britain came off the gold standard in September 1931. Cheap money began on the Treasury's lead from 1932. Most important for the world was Roosevelt in 1933, who literally built the Federal Reserve in Washington, DC, to take policy out of the hands of the Federal Reserve Bank of New York. Other countries followed suit as they followed Britain and the US off gold. So incidentally, I see the failure of the World Economic Conference, or rather differently to Jan in 1933. This was less a victory for nationalist and progressive and protectionist forces, and more a victory for the left and progressive political forces. And finally, there was the Attlee government. Their cheap money policy was explicitly motivated by Keynes's reasoning. And of course, their first act, I think it was to nationalize the Bank of England. But Jan tells us, having set out a full account in his studies in economic dynamics of 1943, Kalecki never came back to his reflections on the role of the rate of interest in the long-term evolution of capitalism. I would contend that the Attlee government and the Golden Age more generally vindicated Keynes's approach. And as I showed earlier, undoing that approach has once again proved disastrous. My colleague on the panel, Bill, in his book about monetary policy in the 1950s, reports that Keynes's colleagues, Richard Kahn and Joan Robinson, were hostile to the end of cheap money. And Kahn took his complaints to the Radcliffe Committee in 1958. But apparently Kalecki was silent. I would be interested to know whether Jan thinks this acceptable. So let me turn to reconciliation. In his book, I sense an attempt at doing so on Jan's part. He sees Kalecki coming round to Keynes's approach to interest rate policy and advocating debt management techniques to set low interest across the spectrum. My minor objection is the approach gives too much emphasis to open market operations and not enough to Keynes's tap issue mechanism. My major objection is that the policy is set only in the context of fiscal policy, and more specifically in the context of funding deficits. I want to offer an alternative reconciliation based on Keynes's sense of power relations that is notably absent from Keynes's approach. In Jan's account, this comes from the interplay of capitalist wealth and the corporate sector, with investment critically contingent on the willingness of capitalists to part with their wealth. But going beyond these specific mechanisms, I sense throughout Jan's work in the broadest sense, a fundamental unease that the world can so easily be redeemed through monetary reform. Having for the past 7 years thought about Keynes from the perspective of the labour movement, I am increasingly in agreement that monetary reform coupled with fiscal policy falls short of capturing the full implications of the general theory. I wrote about this under the title, A Second Internationalism of Labour, in the Progressive Economy Forum book of essays, The Return of the State, which was edited by Jan and Sue Consman, so another book for the collection. On this view, the rate of interest needs to be understood from the perspective of class forces more broadly as the return to wealth. And in a symmetric way, we might understand wages likewise as the return to labour. With any notions of natural rates firmly dismissed, the implication is that both are set according to power relations, and then the disasters of capitalism follow from orienting the system to wealth. And in this way, policy is less about technocratic adjustment of the monetary system and the government's fiscal policies, but a wider and perhaps binary reorientation of the economic system with the needs of labour rather than the needs of wealth paramount. With class forces operating on a global basis, this changed orientation must also operate on a global basis, hence the internationalism of labour. You can read separately how it operates, not least in my blogs on the TUC website for free. But I want to close on a different point. In the general theory, Keynes was preoccupied with preserving a role for market forces and individual initiative. I fear too often markets conflated with capitalism, so any solution partly grounded in private initiative is rejected out of hand. But the general theory tells us that the market may not be so dysfunctional when oriented at the interests of labour. The Attlee government proceeded with a number of nationalisations, but were content with this broader approach. On this view, socialism is not defined by its approach to the state and market. It is defined by its approach to wealth and labour. That's the end of my remarks.
Thank you, Jeff. Thank you very much. Now, I suppose the first question should fall to Jan. I wish the others of you would filter back here, as that there may be questions addressed to you. Okay, well, I think it's better that you start the ball rolling, don't you?
Right. Can I thank you all for coming. Can I thank very much all the speakers for their generosity in commenting on my book. The generosity not only in saying nice things about it, the book, but also in unsettling me with doubts, which will no doubt contribute to further work. I want to thank the Post-Keynesian Economic Society for sponsoring this, particular to Gary, who has spoken, Eva Klavovsky, who's helped to organize this. I want to thank the economics department for supplying Yanis Dafermos to welcome us all on behalf of the department, also for paying for the reception which awaits us downstairs in SG 37 after we've had some discussion. Oxford University Press, I really want to thank Oxford University Press for publishing this book, publishing it with footnotes. You know, for those of us that write books, regret the time, regret the trend in publishing or putting the footnotes at the back. So you've lost your place by the time you've chased up the footnote, or at the end of the chapter, in which case you have to look for the chapter. Oxford University Press is still doing footnotes. So I'm very pleased about that. Oxford University Press also offered copies of this book for a sale at 45 pounds, a discount of £20 at £45. I thought this was outrageous because I actually have an author's discount to buy them at £40. So if you want to buy a copy, I will make available to you a copy for £40. I have copies here. The title, which I think Gary referred to, the title actually comes from the title of Bernbach-Werk's a classic book on interest and capital, and reverses, in a sense, what Bernbach-Werk did was put forward a view that's utterly opposite to the one that I put here. Bernbach-Werk argued that the rate of interest really doesn't need much explanation. What he meant by the rate of interest was the rate of profit, and that does need explanation. True up to a point, but the rate of interest is still there, and I agree with Jeff on this. It does require explanation, even if one's critical of the properties attributed to it. I want to thank Victoria Chick, from whom I learned the fundamentals of monetary economics. Jeff Tiley, who shared with me this education in monetary economics with Vicky, but went in the direction of Keynes's ideas in debt management. And if we had more time, I would explain the difference between Keynes's ideas of debt management and Kalecki's, but I'll just leave it as an interesting topic for someone's for an article. Bill Allen, I want to thank in particular for his book on the Bank of England and the government debt, which came out unfortunately too late for me. By that time I had written most of this book, but it's fundamental because he looks at quite a lot of the same the same material that I looked at, that Kalecki was commenting on war finance. Bill actually looks at it from the point of view of what the Bank of England was doing and its contribution to debt management. So, I think the book deserves, Bill's book deserves a higher profile than I gave it in my book. I just want to record with sadness my debts to two people, Jerzy Szatiński and Julio Lopez. Jerzy Szatiński was the editor of Kalecki's collected works, who died at the beginning of February, and Julio Lopez, who died nearly 2 years ago. With Julio Lopez, with Jerzy Szatiński, I was working on a book on Kalecki and Bretton Woods, and I don't want to overload you, but this book is now available. And just to forewarn you, it will be the subject of a presentation later this year. Let me just say, make a few comments on the substance of the book. I mention in there that Kalecki's ideas didn't change much through his life. His equations did. I mean, he saw himself as a pure mathematician. So what he did in successive volumes of essays on the business cycle was that he tended to change the equations, and then he tended to drop the material on or include some material on monetary economics, only to drop it later on. So what I do in this book is, in the first part of the book, it picks up these fragments. In the first chapter, this is concerned with the financing of investment. Then there is his criticism of Wicksellian theory. Now, this is the sore point for Jeff. The idea that there is a relationship between the rate of interest and the business cycle and inflation. And then there's a further couple of chapters on debt management in the context of war finance. And this includes Kalecki's critique of the Bretton Woods plans. And what I do then in my book is there's a middle section which discusses some fundamental principles. I talk about I think one or two of the speakers have mentioned this idea of capitalist money, and let me just give you some quotations from an early, just to show that this isn't a peculiarity of Kalecki. In his early draft of his general theory, a draft entitled The Monetary Production Theory, Keynes cited in a typically equivocal style a pregnant observation made by Karl Marx. So the subsequent use to which he put this observation was, according to Keynes, was highly illogical. In Keynes's view, according to Keynes, Marx pointed out that the nature of production in the actual world is not, as some economists seem often to suppose, a case of transforming commodities into money and then the money using the money to obtain another commodity or more commodity or effort. As Keynes said, that may be the standpoint of the private consumer, but it is not the attitude of business, which is a case of money being used to buy commodities, which are exchanged for even more money. In other words, for parting with money, commodity or effort in order to obtain more money. So this is Keynes explicitly endorsing this idea that it's capitalists who have the money, and in turning it over in the markets, they are trying to make more money. Keynes gave the source of his Marxian discovery as H.L. McCracken's value theory and the business cycle rather than Marx himself, and then went into typical Keynes, went into polemics with the underconsumptionists Hobson, Foster and Catchings, Major Douglas, and so on. That idea of capitalist money was not so it was not just in Keynes. You find a similar argument being put in in Rosa Luxemburg in her anti-critique. Luxemburg went into somewhat prolix discussion of the social requirements necessary for production in a capitalist economy, including the division of labor, production of capitalist economy. But the exchange of commodities on the market is an internal or family matter among capitalists. The required money for this process, of course, comes out of the capitalist pockets, as every employer must lay out the money capital in advance, and returns into the pockets of the capitalist class after exchange on the market has taken place. So this is Luxemburg's version of what Keynes had just said. And then we have Kalecki's version in his essay on the business cycle, but then this is a point that recurs later on. He's referring to the technical elements of the money market, in which he's trying to explain why investment is possible without prior savings. This is because the expenditure of capitalists is converted into profits for others. The outlay on construction of a fixed asset is by no means frozen, as some people think, and released only as the capital is written off, but is already returned in the course of construction in the form of profits accruing to the firms whose sales are directly or indirectly connected with construction. If during a particular period more money is spent, i.e. out of bank deposits, then pro tanto more money flows back into the banks in the form of realized profits. So this is Kalecki arguing that it's you don't need more money, you need a higher turnover of the money that's already there. Let me move on with the Kalecki's oh yes, the fiscal management of debt, which Jeff mentioned. Yes, this is important, but it's important in order not to cause a rise in liquidity preference. So it's at one point, Kalecki writes about the importance in debt management, that you've got a certain level of liquidity preference. What Kalecki meant by this was a certain proportion of wealth portfolios which wealthy people want to hold as liquid assets. Then the government should be issuing bonds in proportion to that debt, short-term bonds and long-term bonds in proportion to that debt. Why? Because the banking system will expand credit to maintain this kind of maintain the funds available for for investment in these assets. In fact, as the government spends that money, that money will accrue to these wealth portfolios. So it's a time problem rather than anything else. This is where actually development economics comes in with an interesting differentiation, different circuit, because whereas in the capitalist economy, money goes from one capitalist pocket into another capitalist pocket, in developing countries, the money that capitalists and governments spend go into the pockets of the pre-capitalists, wealthy classes, the landowners, money lenders, and so on. And for him, for Kalecki, financing development is really all about making sure that they don't have too much of this money so that the financial system becomes unstable. No one's mentioned the fable on debt repayment, which is actually, it took me a while to work out, is really the fundamental explanation of why it is that it's liquidity that is needed for debt management rather than a surplus or a profit from the real economy. So let me conclude by making a few links with the monetary economics and the monetary dilemmas of our time. We live in a time of neo-Vixellianism, this resurgence since the 1980s of this idea that the economy can be regulated by the rate of interest. Our monetary policy committees sitting down together and agreeing changes in the rate of interest. This goes entirely contrary to Kalecki's ideas. I would argue also even to Keynes's ideas. The whole the arguments that Kalecki was making really have to be made again, and I try to do this in the book. But the other intriguing and relevant point for today is the discussion of debt management. It's absolutely clear that after COVID, with the rise in government debt, we are much more in a situation like that during the Second World War, when debt management is hugely important. And this is why the final this section of this book is on central bank operations and securities, and concluding on this idea that inflation targeting taken too far, given the limitations of economic forecasting, really simply makes monetary policy endogenous to the business cycle. So I want to once again thank all the speakers. Well, I guess we have some time for discussion.
I hope so.
Yes.
Thank you, Yannick. Thank you very much. Time for a few questions from the floor. I'm sorry, I won't call most of you by name because I can't see you very well. But raise your hand and address the person to whom your comment is directed. Yes?
Andrew Trigg.
First, Jeff, what the power of monetary policy and interest rates? With interest rates so low in recent times, how does that relate to the what you were saying about the power of monetary policy? Surely that's happened. Keynes wanted interest rates near to zero. They're not far from zero. They're negative in real terms with inflation. Also, quantitative easing. I wonder what the panel thought about the impact on income distribution, on inequality of quantitative easing.
Yes.
Yeah, I guess that's the right question, Andrew. Thank you. I don't think I don't think interest rates are that low. I think the interest rates on government bonds in advanced economies are incredibly low. Maybe in some other economies are pretty low. But if you want to take a view of the broader return to wealth, if you want to regard the interest rate as a broader return to wealth, then it's incredibly high. Lots of post-Keynesians are writing at the moment about the search for yield. Since the global financial crisis, when policy rates have gone low, there has been a search for yield. So investors are looking overseas for Turkish corporate bonds or whatever you want, real estate bonds and things like that. So I think a lot of money is being channeled into high return investments, perhaps too much money channeled into high return investments, which are probably dangerous. And fundamentally, I think it's a different kind of a cheap money policy to the sort of cheap money policy that Keynes envisaged. Keynes envisaged a very regulated financial regime. He envisaged capital control and so on and so forth. So he wanted low interest rates that would directly affect investments in the domestic economy and likewise for other economies. So I think that world is quite different. But the other thing is that, Keynes wanted cheap money, and he thought that, certainly in the first instance, you had to stop interest rates being high to stop the Great Depression. So that bit was kind of succeeded. But then at that point, you might still need fiscal policy because the MEC has collapsed. Firms don't have any confidence, so you need some fiscal policy to get things going. And contrary to much discourse, there was fiscal policy in the 1930s. There was fiscal policy in the UK, and of course there was fiscal policy in the US under the New Deal. So policymakers were acting to support the economy, which was pushing the MEC out from the sort of slumped one to a better place. So things were working in a way that they're not doing now, because that's one thing. It's all about monetary policy. It's all about the power of the Bank of England. It's all about QE, but it's been nothing about fiscal policy. So there's a sort of answer in that ramble that one, it's a very different cheap money policy that we've got at the moment, not in a regulated environment and an absence of fiscal policy. And I think it's probably a dangerous cheap money policy as well at the moment, because of the way money is being pushed into all sorts of investments around the world that might be a bit precarious. And we might be seeing some retreat from those investments at the moment. Top.
You asked about inequality, and I haven't got anything very profound to say, except to make the obvious point that you have to distinguish between wealth inequality and income inequality, and that wealth inequality will have been inflated, if you like, by quantitative easing, which has forced down bond yields and forced up asset prices, so that the wealth of people who owned assets already has gone up, whereas that of those who didn't hasn't. And one might expect that as quantitative easing ends or even gets reversed, if ever happens, that the wealth inequality will adjust back. Income inequality, I have no explanation of, and I think that it's that the causes must be quite profound and certainly beyond my comprehension.
Yeah, let me just say a word about inequality and QE. In a sense that, just to comment that I pointed to the provocative distinction that Jan makes in his book between the money of the state and then the money of capitalists. And one thing that leads back to it, and as I was preparing my remarks, I was thinking, well, the financial system and backstopped by the Fed and so on is kind of in his category of the money of the state. And the idea is the capitalists are taking care of themselves and so on. And in a certain way, quantitative easing is the extension of that. What we see is the explosion of asset prices, widening inequality, disenfranchised workers, and angry and taking self-destructive actions such as Brexit and election of Donald Trump and all of that. And I think in some sense, the question, one reason to really read and reflect on Jan's book is, because I already debated this with Silvana, was what is a capitalist? You know, what is a capitalist? Is that, you know, that buccaneer, I'll eat you for lunch capitalist, you know, the Bill Gross types, financial capitalists in our day, are they the same ultimately? Jan provocatively said, well, M prime. Okay, fair enough. What about the C in the middle? What about the labor that used to earn that money? Now you say, yeah, it goes across borders. That's right. But that problem is now globalized. So I think that, you know, there's a profound reflection that we all have to have, because if I'm not mistaken, the Labour Party itself was going very softly when it came to their chance, even under the Corbyn days, to critique the City of London. Everybody's afraid about that beast, and these people are what? They're basically, you know, tax haven enabled, tax payment avoiding. Shall we tax wealth, or shall we just let everybody pay more money and turn off their heat this coming winter? You know, these issues are right on the table, and we have to ask ourselves, who is this capitalist, and what is the relationship to something called labor? So while I challenged the adequacy of those, and of course, you know, we rip each other apart, the working class versus the Afro-Caribbean Britons and all that, you know, we rip each other apart. But basically, those questions are there. Who is labor? Who is capital? And how does that come together? Those are the fundamental things that in Koleski's work are always front and center. And in Jan's work.
Hanna Szymborska, thank you very much for the excellent contributions. My question piggybacks a little bit on Andrew's. A lot of the speakers rightly criticized the rather narrow space that monetary policy occupies these days, mainly focusing on interest rate management and to some extent open market operations. So my question firstly directed to Jan, based on Kalecki's monetary economics, what new action or intervention could monetary policy take to think a bit more creatively about ensuring prosperity in the light of the challenges that we face today? And I would also welcome other speakers to contribute to answering that question based on your expertise. Thank you very much.
Interest rates?
Can I just say that I think the real function of the central bank in this situation is a technical one, and it should be this one of assistance with debt management. If you want to call it the broker of last resort or whatever, it's really to maintain and regulate the liquidity of the capital markets, so that the government can issue the bonds or obtain the financing that it needs, but also so as to ensure that the markets do not get so liquid that they become unstable, and that's I think it's this technical role. I'm in this respect, I guess I'm a bit old-fashioned. I think that I believe that it's the same thing about banking as well. I think they should maintain a low profile. And not put themselves forward as masters of the universe, because that way lies hubris and disaster.
Anyone else?
I agree completely with everything that Jan said. I think that when people join central banks, they should be required, like doctors, to take the Hippocratic Oath. First, do no harm. And the harm that they could do is, as Jan said, to not do what they need to do to enable governments to finance themselves properly, and importantly too, to contain surges in inflation, which do great social damage and need to be stopped.
Gary?
Just a couple of quick thoughts. The one is that keep in mind that actually everybody will remember the Rebuilding Macroeconomics project that NISR sponsored, and some work was done by some people in this room, and I participated in some of those dialogues. And one of the dialogues was whether or not, in the view of many of the core participants, whether fiscal policy still counted as macro policy. So that this reminder of these connections is fundamentally important because it was just written out by many people, and the Masters of the Universe comment is right on point. There's things you can do, but you can't do everything, and so in some sense and that's where actually then the management of debt becomes something that is a way of refreshing and renewing some of that commitment to social spending when necessary, support payments when necessary, and so on, that we're not living in a world in which every household has to balance its budget every year, every month, therefore so much the state. This is a way of reinterpreting and refreshing that argument that compassionate and constructive approaches to infrastructure and social welfare have to be part of the discussion. When I was working in California with the legislature there, the very wise woman who was in charge of the state, the finance for the state, used to say a budget is about who you are as a people. And that's something that gets completely forgotten in these days.
I can't resist this one either. And basically, I agree. I think one of the trouble is, I think the horse may have bolted here. You know, we should have done fiscal policy in 2008 to get the economy going, and then start thinking about what a proper economic system might look like. But we didn't. So the QE, I suspect, has fostered more for that. You know, rather than resolved the crisis, I suspect it's exacerbated the debt imbalances and the financial disarray. So it makes me quite fearful, you know, so maybe there is no easy answer to the question, because as a result of not doing the right things 10 years ago, we might have created a bigger mess that will be even harder to clear up now.
Yes? Oh, he's leaving. No, he's not leaving.
Cheers. Yeah, thanks for this. Particularly interested, particularly from Jan, your view on whether interest rates themselves can actually have much of effect on inflation, particularly the inflation we're seeing at the moment. And I guess back to similar to other questions, whether, you know, we should be looking at non-interest rate mechanisms, whether that is other forms of monetary policy, like people have been talking a bit about the use of reserve requirements, which I think was a debate in the 1970s about how that should be done. But also, I guess, what other policies, fiscal policy, or is there nothing we can do when it's, you know, supply side inflation?
Yeah. Okay. I on the question of inflation and the rate of interest, I would refer you to what Keynes called Gibson's paradox. This is in the treatise on money. What's Gibson's paradox? Well, Gibson's paradox was discovered in the by a statistician called Gibson in the 19th century. It really goes back to Took and his history of prices in the mid and early in the middle decades of the 19th century. This is the discovery that interest rate, if you look at the progress of interest rates and the progress of inflation, they're both pro-cyclical variables. They both tend to rise in the boom and fall in the recession. And the real question is, how can that be? Well, because the whole the whole of the kind of neo-Vixelian project is around the idea that they should be inverse, that you raise interest rates and the rate of inflation should come down. But it doesn't historically, and the way it's got round in the statistical models is to introduce lags. And of course, if you introduce appropriate lags, you can bring back your idea that yes, if you raise interest rates now, then in a year and a half to 2 years' time, this may bring down the rate of inflation, but it may not. On the non-interest rate mechanisms, reserve requirements, and so on. Yes, I think that one one does need to maintain control credit, but I think one of the ways in which one of the important ways in which one can do this is by controlling the liquidity in securities markets. Banking today is all about lending against security, and if they if the central bank is doing its job properly, regulating the liquidity of securities markets, there should be less of this, less pressure on asset prices, and less possibility that the system will become unstable. But it's not something where there's a simple answer. And the problem with the old joke about to every complex difficult problem there is a solution that's simple, clear, and wrong. And it's the simplicity. If anyone comes forward with a simple solution, the chances are it's wrong. And the rate of interest, inflation targeting was one of those, I'm afraid.
Yes, Bill.
At least one of the questions was, can interest rates be effective in dealing with cost-driven inflation? And I think that it's helpful in thinking about that to look back at the pandemic, when the main features were, firstly, that production went down a lot because people couldn't go to work and production facilities closed down. But incomes were maintained by furlough schemes and other government subventions, so that there was a very large budget deficit. So households in aggregate, not every one, but in aggregate, built up large amounts of money because they couldn't spend it, but they were getting paid it. And it's not entirely surprising that when the whole thing came to an end, they could go out and spend money, that prices went up because they all wanted to do home improvements and whatever. That was foreseeable, and it could have been dealt with either by taxing away some or all of the money that was floating around, or by putting up interest rates so that there was an incentive to save it rather than spend it. If either of those things had happened, then the demand for products wouldn't have gone up and the prices wouldn't have gone up. So the answer to your question, I think, is unequivocally yes.
Right. And during that lockdown, and after, I saw Jagjeet Chadha, the director of NISR, consistently make the point in these meetings of Treasury folk and others on these Tuesday morning sessions that, yeah, people got the savings. We need to spend money. What's the problem? There was no problem. But I would also just comment that you're going to see a pillorying of the Federal Reserve Chair in the US and the Bank of England chair here, because they're faced with almost impossibly complex choices with no simple answers, as Jan has said. And it's just easy to make actually both of them whipping boys for, well, we acted too late, we didn't do the right thing. It's way more complicated. And so we have to be careful. There was not a magic bullet that could have been fired.
I think maybe there isn't a magic bullet, and the problems of coming out of the pandemic are obviously incredibly complicated, and the nature of global supply chains, the lack of production at home. But I think that we have to distinguish what's happened since the pandemic with what was going on before the pandemic, because I think before the pandemic, the major problem in the world goes back to that distributional question, was that wealth had an awful lot of money and labor didn't have a lot of money. And Jan alluded to underconsumption and overproduction arguments, and I think that was probably the more dominant feature of the global economy, that the global economy had been producing too much for too little spending power. So for me, that was the underlying situation before the crisis. And of course, policymakers kept trying to somehow make that better by reducing spending power even more, which wasn't working. Then we have the pandemic and a different set of problems. But I don't think it gets away from the fact that there's this very fundamental dislocation between a mass of wealth in the hands of very few people and just not enough money in the hands of workers and people who buy stuff. So whatever the answer to the immediate question of inflation, the bigger questions are around that broader distribution between wealth and labor. And I think it's very important not to lose sight of this and turn it into whether central bankers are doing the right thing or the wrong thing at the moment, because as Gary says, they've been dealt a very bad hand, but maybe they started it in 1980 or whatever.
So far, we haven't had an answer which is simple but wrong. Lots of different.
Going back to the question about inflation. Thanks. Yeah, going back to the question about inflation, whether it's demand-driven or cost-driven. I've been doing some work on this, and the US at this point in time, inflation in the US is slightly different to inflation in the Eurozone. There are different factors affecting trends. It's the demand factor is stronger in the US. It almost doesn't exist in the Eurozone. And that's one point. And if you look at the actual statistics, then you see that half the inflation rate in the Eurozone is due to two things: energy and unprocessed foods. So to my mind, this is a very clearly cost-driven. And I have the same question as a colleague there. I think raising interest rates at this point in time, at least in the Eurozone, is wrong. And somehow Lagarde seems to be holding back. But I mean, I'm looking for this simple but wrong answer, and I don't have that. Okay, if that's wrong, what do? Price controls? Galbraith, 1970s, said price controls, strategic, big firms that you can't control, that you can actually, follow and control, supervise, survey. You price makers, in other words. So there is no. I mean, taxing is another sort of probably way of going about it. But it is a big question right now. And raising interest rates probably will produce, recession, sort of deepen recession. So we'll have the next set of problems to be discussing soon. Thanks.
Let me just start an answer to that by just mentioning that a colleague who worked in our country is now moved to UMass Amherst, Isabella Weber, has written a very well-received book about China, very excellent book. And she did an op-ed, I think, in the New York Times or The Guardian, okay, in which she basically took it and, she analogized and said, isn't this a time to start thinking about it for the reasons you're mentioning? And she, speaking of pillorying, she was pilloried by no less than Paul Krugman in a sexist and gendered way. Now he backed off. He's an arrogant guy, as we know, but still, I would ask the question, because we've got people here with great government experience in the UK. Would we reach a point where price controls, even in some of the sectors, such as you're mentioning, could be on the table for this government or another government?
I can imagine it. I mean, I think it would be it would happen if there'd been a serious failure to contain inflation by fiscal policy or monetary policy. But if you get into a really chaotic, dislocated, disordered situation, it might happen.
Not impossible. The trade war with Europe and all of that. Possible,
Can I say that the very significant intervention here has been Mario Draghi's suggestion that what we need in Europe is an oil energy cartel formed within Europe, and if anything is going to make that kind of price control work, it would be something like this, and coming from the mouth of the former head of the European Central Bank.
But that's where, Jan, in your book, again, people need to read the book and reflect on it, because you had various key points talk about how there's a need for planning and control, and it has to be cross-border. What are those institutions? We have the different rules. They're even debating in Europe, what are the rules we're going to use, majority rule, et cetera. Are they going to change some of the things? So where is that cartel of consumers? What would be the mechanism? OECD? Come on, that's not going to happen. How would that work? And so on. There's huge institutional challenges to be resolved, even at the global scale, even as we speak. I guess we need to go to your Bretton Woods book.
Can I be cheeky and ask two short questions? First one, you mentioned the shortening of maturity of the Bank of England balance sheet and sort of consolidated public liabilities as a result of QE. Do you think there's a danger that the bank gets worried about, as interest rates rise, bond yields rise, capital losses and costs to the balance sheet, and react by perhaps aggressively trying to sell off quantitative tightening, because it doesn't have the option of letting them mature in the same way that the US does, because they're shorter. If it did that, what do you think the effects might be, particularly in terms of financial stability and government debt management? And can I just quickly ask one other short question? My reading of Kalecki, as Gary pointed out, and to a degree Joan Robinson, is that they mention monetary things here and there, sort of for a few pages, and then move on. Is it because they just don't think they're that important and interesting, and it's sort of obvious how public balance sheet works and bank mechanics of lending works, in contrast to some economics today? There's lots of discussion about the sort of nitty-gritty of monetary balance sheets. What would Kalecki and Joan Robinson think of sort of modern monetary discussions? Would it be fair to say that there's too much focus, or is it another reason that their comments are so scattered? So I stop there. Thank you.
Well, you go first. It's a very big question. The Bank of England, unfortunately, bought very long maturity bonds, so the half-life of their portfolio is 8 years, which means that by 2030, they'd still have half as many as they've got now, which would almost certainly be too many. Obviously, selling them actively in the market is a kind of slightly more scary thing to do than just letting them run off. There's no particular reason, I think, why it should be more disruptive to the market. It's just kind of bureaucratically more intimidating because it's something you're kind of doing yourself rather than something you're letting happen. To my mind, by far the best way of doing it would be, well, there are two ways of doing it, but I've proposed one way of doing it in one sense rather quickly, but I won't go into that because life's too short. But if they're going to just do it in the way that you would expect, I think that the simplest thing to do would be just to say every year to the debt management office, we'd like you to sell this amount on our behalf. And then they combine that with the regular debt management sales program. The guys in the debt management office know what they're doing. And that's probably quite the least disruptive way of doing it. I can't see why that should be particularly problematic, but obviously there'll be a limit to the amount that they could do each year. And it might not be predictable at the beginning of the year, how much they'll be able to get through that year. There might be complications, but again, we haven't really got time. Well, I haven't got time to go through them unless you want to be here all evening.
His second question, I think, is for you.
Do you want to speak?
No.
This is the second question. Sorry, I was taken. What was the second question? Oh, yeah. I think that the Kaletsky and Joan Robinson were mostly writing in this long period between 1929 and I guess the 1970s, when the financial systems around the world had become discredited, had become illiquid, and this caused a whole heap of problems for government debt management, which actually Bill writes about in his book quite nicely, because the capital markets, the bond markets, were relatively illiquid. I think what's happened since then is the 1970s, 1980s. You have the shift in pension fund, shift towards funded pension schemes, the pouring of money into capital markets. Another boom and bust after 2000. So you have there is a sense in which finance has become much more visible because it's more unstable. And I guess they were probably, if they were around in at the turn of the 21st century, they would have they would possibly have written much more about finance. But it was at the time when they were writing, finance was something that caused problems for government borrowing. It was causing problems, the problems of international debt, which had to be managed, but not the type of problems of instability of asset prices, which we've come to be used to.
Perhaps one more question. There is one.
I was just asking for a clarification. I don't know, maybe Jan or Gary. You mentioned that the book challenges the way stock flow consistent modeling, the place of equilibrium. So I didn't really catch it. Like, what's the place the equilibrium takes in stock flow consistent modeling, and what is the challenge? Just a clarification.
Okay, just briefly, when Tobin and Brainard, there's a paper from, I think, 1968, where they talk about the adding up constraint and the fact that, you know, there's a kind of Ballrau's law thing, or, you know, that if n-1 markets are in equilibrium, then the nth will be as well. But when you do one of these models, if you're kind of looking at n-1 markets, whatever you're not taking care of is going to be sloshed into the nth market, and you could have some very perverse and unanticipated, you know, implications for what would have happened to everyone's portfolio. So it's a warning that you have to make sure that everything's going to balance out. That, you know, those are models that are full of substitution effects and lots of interest rate and risk and all this stuff. It's a real, you know, sort of market efficiency kind of a frame. Now, as we take that forward into our era and so on, that logic still pertains, because of course it is true that you always have to watch for that when you do something that has multiple assets, a model with multiple assets, and especially when you're tracking dynamics through time, you're always pulled back to that equilibrium. And that becomes a test of whether or not a model is a good model, is one of the tests. It becomes a real constraint in the sense that you are insisting that everything's going to add up using the asset markets and their quasi-equilibrium as the frame for that, while lots of other stuff can be going on in the flow space of your model that you're not controlling for. So this is why I said I mean, Giannis was up here and he's one of the real masters of this sort of approach, and Joe's here, and there's people in this room who are just amazing at it. And the challenge is, you know, how do you tell stories about the dynamics, the flow dynamics, or the circuits, whatever you want to call it, in real time, talking about the dynamic with a rich enough frame of asset markets that you've got a real economic framework to talk about, especially in our age of financialization. We're going to need, you know, asset markets, we're going to need debt markets, and so on. How do you do that in a way that doesn't sell out your description of the real movement through time to implicitly a return to an equilibrium that you don't believe in? That model insists on it. But I saw one of our friends from Limerick University just, again, pilloried in a rebuilding macroeconomic session by one of the leaders of that enterprise, and basically said, don't tell me about stock flow consistent modeling. Every general equilibrium model, every DSGE that we insist on as our badge of honor, what we do as neoclassical economists, we always are stock flow consistent. Now, and I mean, what I did not say, because it was not the moment, would have been, that's because there ain't nothing going on in your model. But that was not the moment to make that comment.
Anyone else? Okay. Well, I think it's time that we stop this session, sad though it is. And I hope that you'll join me in thanking all our wonderful speakers for this afternoon's entertainment. Enjoy.
Can I thank you all for coming? There is downstairs a reception with bubbles and with refreshments provided by the economics department. Eva, you know where it is. So if you follow Eva, you can make your way down there. We'll be bringing the copies of the books downstairs.
Sorry?
This guy with the black t-shirt behind Paul.
I can't see well.
Can't you?
Sorry.
Fair enough. You'll recognise him when he's closer.
Yeah.
So, where's your specs or your eyes? Yeah, they're just too. You're astigmatism.
Macular degeneration.
There's a. Is it? So you can, am I okay? Where's the?
Oh, yes,
Yeah.
yes, you're close enough.
Yeah, the shit.
Hello, how are you? Sorry, I couldn't hear you just now.
I mean, that some people.
It is.
If I buy a government bond, yeah, I'm not getting money.
Uh-oh, send it again.
I need a lot.
Send it again. I don't know where it went. I'm very, very sorry.
I'm taking a lot of risk in order to earn a high rate of return. Shift. Reduction in interest rates that policymakers have done haven't created a low
It takes
interest.
nerve, but you should have done. Anyway, do it now.
I've got a section size. Yeah, so I think increasingly we've gone towards higher risk. Yeah, which is essentially just the return to wealth. The return to wealth has been astronomical, hasn't it, since over the past 2 years. Then that was related to it. Yeah, so somewhere, you know, so they're not getting very much. If I've got a wealth fund, I'm getting nothing from my UK government. So I'm investing in real estate, I'm investing in overseas bonds, corporate bonds. Does that make sense? Yeah. Thank you for this. And I think that the same people were